Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. Continuing to review the playbook over and over at the moment, I think it's a very, very advantageous thing to do. I'm still very much the belief that longer term, the US dollar over the next 2 years has a very strong case to make, and that it's clear the US economy is probably ahead of most other parts of the world. Its reopening is ahead of where it should be, which is also a very positive thing. And we know that the Federal Reserve is going to start moving policy consistently over that period of time, whether that's through quantitative easing or through rate movements. But as we've also pointed out, that doesn't mean that it's going to be a linear appreciation, and it needs to be very clear from last week's data that that's the case. We did talk about this last week. We said that euro dollar looks a little bit oversold, and it probably is at 115, and it got down to as touch 115.1 at one point last week. That is too low in my view. I don't really see what is going to really jump it through to then go to 114 and even towards 112 over a medium period. There isn't really any news there to really push it because we know what the Fed is doing. And that came out last week in their minutes, and it very clearly said nothing that we didn't already know, just that we're basically there, and that if they are going to start, it'll be probably in either mid-November or mid-December. History suggests it'll be the first one rather than the second. But what was interesting was the inflation data, and this gets back to the rocky nature of what we currently find ourselves in COVID. Inflation was better than expected on the September numbers on the headlines, and that's because food, fuel, and transport were ahead of expectations, and quite significantly ahead of expectations, along with new car sales. If you strip them out, inflation was actually about right, if not slightly weaker. But what it does show you is that supply chain issues are going to be a theme for the next 6 to 12 months. And that may therefore interrupt the growth profile. It therefore very clearly separates liftoff and quantitative tapering. That is where we are now currently at. And the tapering of quantitative easing is the here and now story through to June next year. But if we do get those headaches from supply chain issues slowing down the growth in the US, the probability of having liftoff at the end of next year will get less and less likely. And therefore the differential between the Eurozone and the US will slightly close up a little bit because the Eurozone is still stimulating and will probably therefore grow slightly faster than what the US has in next year because they've already had their growth this year. Doesn't mean, as I said, longer term it's going to be that way. We know that the ECB is going to be a much more accommodative stance position than the Federal Reserve, so that by nature will mean that that differential between central banks will push the US dollar up. But in the meantime, I do see it having a possibility of going through not just 116, but maybe even back to 117 heading into Christmas. The caveat to that is the yen. The yen at the moment is under incredible pressure, not just in euro dollar, but across the board. I still want to stay with euro dollar. It's the easiest one to look, and it hit a 3-year high last week at 113.5. It's not slowing down, even though it eased back because yields in the US 10 years eased back and real yields eased off ever so slightly. Yields are only going in one direction, and that's up. And for that reason, I'm still fairly strong on the idea that being long that pair is fine on pullbacks that you see. I understand it's starting to be in upper echelon areas, but the play there is much different to the euro dollar. So continuing to review that, they're trades that are working, that's why we want to stay with them. We just have to keep reevaluating and also follow the momentum and make sure we catch that too.